Okay, here's a fun position to think about. A few days ago, I went into the 10-year notes and I sold a call at the 110 and a half strike line. I received a credit of 25 ticks. Um, a full point from 110 to 111, as an example, would be 64 ticks. Half a point would be 32 ticks. 64 divided by 2. All right, so I currently have this short call, which is showing a profit right now because the market is currently trading at 10 bid at 11. So if I close it out at 11, I'll receive 14 ticks of profit, and each tick is worth 15.62 and a half. So $15.62 and a half cents. All right. So what can I do with this position? I can do a few things. I can do nothing and continue to collect the theta that I'm collecting for being short the call. I can close it. Currently working a bid to pay 10 for it, or I can turn it into a vertical, and there are a few ways I can do that. If I buy the 111 for, let's say, 5, then I would be short a call vertical for half a point, 110 and a half to 111, which means that I would have 32 ticks of risk on this half point. However, I sold this 110 and a half for 25, and if I buy the 111 for 6, then the profit will be 20, and that would limit my risk to 12 ticks should the notes rally past 111. We can take a look at the visual of that in the following. So, as I mentioned, I will have 12 ticks of risk to the upside. I have no risk to the downside, and guaranteed profit of 312, approximately 312 and 50 cents, $312.50 for prices at or below 110 and a half, which is where the short call is. Maybe I can also, if I pinch the wing a little bit and I sell the 110 or buy the 110 in the orders, okay, that lowers, or it compresses the length of the call vertical. But notice if I do that and I pay, looks like the market right now for this call, the 110 in the orders, is 7 bid at 8. So let's say that I paid 8. Remember, I sold a 110 for 25. So I would have 17 ticks of profit, and this quarter point call vertical, the max that it can lose is 16. I have 17 ticks of profit, so that would leave me with a worst case scenario of a guaranteed profit, very small, and then I still keep most of the profit, which would be a little more than $265 at prices below 110 and a half, at or below 110 and a half, which isn't bad because if I don't do anything right now, my max profit would be 390 if I let the call expire worthless and prices stay at or below 110 and a half. So some interesting choices here. If I want to remain delta neutral, so this position is currently the equivalent of being short about 23 delta. I can go out and sell. I'd rather sell let's see what the open interest is, just out of curiosity. So the 108 in the orders has 3,000, a little more than 3,000 contracts of open interest, and the 109 has 126,000, so considerably more. But if I wanted to get about delta neutral, right around delta neutral, I could either sell this, the 108 in the orders, for, let's say, 12 and a half, 12 for 13, or I can sell the 108 and a half for 9 or 10. And then I would have converted this short call into a strangle. So I'm going to have negative gamma, negative vega, and I'm going to have risk. Where's my risk here? There we go. So I'm going to have risk outside the wings, 108.5 and the 110. But this would basically, selling this put would center the strangle around current prices, and having a lead on the call because it's already in the profit zone helps. So I'm basically centering the strangle lower than it would be if I started the trade initially as a strangle. Okay. Oh, not so sure about this. I really don't know. For the time being, I'm going to take a few minutes to think about it. If I want to have this structure as opposed to what I previously showed, where I can leave myself a little bit of risk by creating this call vertical, and there's a little bit of risk, or I can compress the length of the vertical a bit and make sure that I have zero risk. If I paid 7 for this, I can currently pay 8, and I'd basically be done with the trade. I just let it bleed out, let time expire on the clock. Maybe I can buy this for 7 and do this. So I'm going to keep most of the profit, and if it rallies, worst case scenario is I make a little bit of money, barely cover commissions, but we'll cover commissions, but not much more than that. We'll see. I'm gonna spend a few minutes thinking about it, but I thought I would share this trade because it's a somewhat interesting setup. And again, this is just a one lot call that I sold a few days ago. When did I do this? Last week? Oh, this week. Yeah. Friday. No. Yeah, it was last week. I did this last Friday at about 7:15 a.m. Pacific time. So anyway, I thought I would share that, and I'm not sure what I'm going to do. I'm going to spend a few minutes thinking about it. Like I said, what would you guys do? What do you think?